So the sort of fundamentals of asset allocation were laid out in the 1950s by Harry Markowitz, and it's known as modern portfolio theory. So modern becoming a little bit ironic. As you can see, the number 2 point there is that MPT does assume that investors are risk averse. So that harks back to our investment objective. We should be defining the level of return that we want and the level of risk we are prepared to take. So modern portfolio fits in with that very nicely. And indeed, at RES, we quite often use the modern portfolio theory to inform the investment objective. So for example, if a client thinks they want to outperform and deliver, say, a 9% return, we can let them know the probability of them achieving a 9% return, and more importantly, if they try and get a 9% return, what their downside risk then becomes. So you can actually use this to inform the investment objective, as well as devising a strategy to achieve your investment objective. Now, there's only 3 key inputs that we require. We require the expected return from each segment, we require the risk from each segment, and we require the correlation between segments. So we're about to look at those inputs. Now, what I'm going to do to illustrate, because I only have 4 slides, is I'm going to illustrate it by not using the algebra in modern portfolio theory, and hopefully this will illustrate the point. So I've just chosen 2 sectors. These are UK sectors. So here you can see in the chart, I've got the pattern of total return from city offices in grey, and then for regional industrials there in blue. And you can see that return pattern over the last 40 years. Now, from that data, we can extract an average return. So for city offices, that's 8.4% per annum. For rest of UK industrials, that's 10.3% per annum. We can also calculate the standard deviation, which is higher there for our London offices. And we can compute an average return per unit of risk. So the simple idea is that you want the highest possible return for all the risk that you're taking. So you can see regional industrials over 1, far superior there to London offices. So our asset allocation would be to decide what proportion of the portfolio we put into segment A, city offices, and what proportion into segment B, rest of UK industrials. So without using modern portfolio theory, we might decide to put 50% in both segments. And that will roughly give us an average return there of 9.4% with a standard deviation of 9.8%. So I'm not using any clever algebra here at all, but you'll note that our average return per unit of risk there at 0.95 is not superior to the regional industrials, which generated 1.03. So simply using this measure, we can see that actually this portfolio is not better, and you would be better off putting all of your weight into rest of UK industrials. So just sit back and think, okay, I want to do that, but I want to do it for every segment in the market, and I want to work out all the individual segment weights that give me the best return per unit of risk. You could do it. It would take you an awful long time. So the magic of modern portfolio theory was simply to reduce all the calculations just based on the expected return, the correlation of returns, and the standard deviation of returns.